All right, we're going to get started this morning. Thanks everyone for joining us. Welcome to today's Technology Association of Oregon webinar, Strategic Plan for Exit, sponsored by 40 Strategy. I'm Riley O'Brien, the Vice President of Events and Experiences at TAO. Should you have any questions or issues during the webinar, feel free to send me a private note through the TAO admin profile. A couple of rules of engagement before we get started. And I should probably do our slides as well. That's me on the big screen with my fancy picture from the summer where we could all socially distance and get our photos taken together. All participants have been muted. If you prefer to ask a question, you can do so in the chat box. We're kind of a smaller group today, so Carl can make the decision if he wants folks to be able to unmute to ask questions. We'll let him respond when he gets started. We ask you to engage via the participant icon on your screen. And if you have any questions that you want to ask me directly or to Carl directly, feel free to do so in the chat as well. Please engage with us on social media during this call. Feel free to take a screenshot if you want to. And throughout the day, we'd love to share what's going on with TAO and the programming that we have with our community and get participant takeaways from all of our events. Thank you again to Carl and 40 Strategy for hosting this program. We love the professional development and programs that we can offer to our community, so we greatly appreciate all of his support. And finally, it's my pleasure to introduce our presenter for the session, Carl Cox, who is the CEO of 40 Strategy. Take it away, Carl.
All right, thank you so much. Appreciate the introduction. And so if you haven't been a part of a presentation that I've done in the past, they're a little bit different than the normal one. So that means you actually have to be engaged. If you do have your camera on, I'd appreciate it because then I could actually see if you're paying attention because that's what I prefer. And then also in line with that, because there's not 500 people here, I want you to feel welcome to turn it off mute and just go ahead and speak. So I don't know if we have to do anything in particular on our side, but just feel welcome to go off mute if you want to throw in a question as opposed to following along in the chat box. So that's just a few of the house rules. I'm going to be, how I like to do, I'm going to actually use a little iPad. So I'm going to connect into that right now. And once we get this up and running, that's what we'll be doing the presentation through. So I'll have two different parts here to view. And we're going to go into Notability. All right, so hopefully you're in the right place, which is a strategic plan for exit. And as I said, since there's only a few of you, you're going to have to be like super active because I actually have questions in this. And so I want you to feel free to throw out questions when you have that. So here's that lovely view of Portland that we have. And one of the things is you got to think about when you're getting ready to think about exiting a company, it kind of feels like you have to get to that top of that mountain, right? And start to go there, but you have to, there's a long journey, especially if you're walking on foot. Sometimes it feels like you're crawling to get up to the top of the mountain. So we're gonna talk through that just briefly about who I am. Once again, appreciate the introduction. I'm the CEO for 40 Strategy, and there's a concept that I've learned just with working with organizations and from my own personal experiences that organizations spend about 2% time of their time on strategy. And so that was kind of the concept of 40 hours. You do 2% times 2,000 hours in a year. That's about the equivalent of 40 hours, and that's where the 40 Strategy concept came from. And we developed a 7-step process to help navigate your strategy with purpose. And so we go through those steps with all of our clients to help make sure that we can help work with them to make things work. We do strategic planning, facilitation, executive coaching. All in all, we don't build just to make plans, we build plans to make them work. And so that's kind of what we try to focus on a regular basis. A little bit of history I know some of you who are out there right now, and I certainly do not want to proclaim to be the expert on M&A. Let's make that noted, okay, right now. But I do feel like I have a fair amount of confidence of strategic plans, and I have been involved in a fair amount of M&A activity. I've helped lead 5 companies to have 3 to 5x growth through their period of time of being with them, either as an executive, as a board member, or as the CEO in these respective companies. Started out early in the days as a CPA, and back in the day when Coopers and Lybrand, if you recall that organization, now called PricewaterhouseCoopers. So that's where I started. Janelle, I actually got an offer from Moss Adams that I actually seriously considered. And so I almost went towards that, but I ended up starting that. But I was on the 2 and out track. I found out business assurance is auditing people who don't want you to be there. And so I ended up moving off and doing some other things as I got recruited away. I've been a CEO, a CFO, a finance operations leader, board member, consultant. I've directly been involved, as I said, in multiple corporate situations, both on the buy and sell side. So I actually have both viewpoints of how they go through. And I've worked in 4 different continents throughout my career. So the basic concept, once again, is this navigate strategy with purpose. We're not going to go into detail with this today, but I do believe there's a process to help get things done. And when you have it be clear and concise, things typically work a little bit better. I wanted to pull some data for you just to say what is going on in the market. And so we can take a look at this. This was pretty cool. I actually put this on LinkedIn a little bit earlier, a cool little pictorial of seeing all the different acquisitions that have taken place. This is just some of the biggest tech acquisitions that you had. A $40 billion NVIDIA of ARM, and probably many of you heard of Salesforce buying Slack for $27 billion, Morgan Stanley, E-Trade, et cetera. And of course, there's been local acquisitions here as well. We got barely any public companies left here in the Portland metro area. So there's been a lot of changes that have taken place. And then you've probably heard, if you've been paying attention, there's this concept of SPACs, and we sometimes get this belief that these are special purpose acquisition companies. Shaquille O'Neal even has, you might be familiar with him, the basketball player. He even has his own SPAC right now. Basically, what a SPAC is they form it's a company that's publicly traded, and they use that opportunity to buy existing private companies. So it's accelerating some sales than it used to in the past. You could see here in this graphic, $83 billion basically has been on special on SPACs over just in 2020, and 8.4 billion alone just in the first month. So it's kind of accelerating a rapid pace. IPOs have also had a massive resurgence. The most, really, almost, I think this might be in history, at least through this 20-year period that we're looking at. 2000, recall, I remember that period vividly because there was actually, you might actually turn off once you hear this little statement. There was this little company that had lost, I think it was $300 million, and I sold about 4 to 5 shares of their stock because this little, it didn't seem like this little book selling company was going to make it online. That of course is Amazon. So you could go ahead and hang up right now, but just to let you know, I actually did get reinvested, and there's another whole story with the investment club that I have that has funded our annual meeting on a regular basis. So I did get back in the Amazon train, but I literally pulled this up today. I sold 4 for $13. So this was pretty painful to look at that, looking back 20 years ago. But IPOs have had a resurgence. But what's really interesting is this right here, is that M&A is actually technically down. Even if you add in that 83 billion with SPACs and you add in some of the IPO levels here, M&A activity has actually had a downward trend, and it hasn't been as high as it's been back in 2007. Why am I putting in global data? The reality is companies are buying people all over the world now. There's not just because the United States were being held back so I thought this was pretty interesting to see that the trend isn't necessarily as high as it used to be. This had a little bit of a growth period here due to the baby boomers, and they were selling their businesses. So there was a little bit of a trend that was taking place, but that has decelerated in the past 5, 6, 7 years, and had its lowest level in 2020 since quite a long period of time. All right, so this was where input starts, and you're welcome to turn it off mute or to put in the chat. I prefer you just say it out loud. We're going to take a look at this first from the buyer's perspective, right? As I said, I like to have a seller and a buyer perspective, and I think this is often why a lot of times strategic planning fails. It's because we only look at it from one perspective, and then we end up having failure as a direct result of that. So give me some reasons why and by the way, I have data that I'll show afterwards, but what do you think are some reasons why acquisitions fail from the buy side perspective? But and by the way, they say at least a third fail, a third are like they shouldn't have done it at all, and a third is because are reasonably successful. John, what's your thought?
First thought would be cultural integration.
Yep. Okay. It's a good one. Okay. Who else? Who has some insight? It can't be just John answering. Len, you got something here?
Yeah, I think lack of preparation for being acquired.
Yeah. Okay. Okay. And remember, we're thinking from the buy side perspective, like why are buying companies, why do they fail when they buy something? Anybody else have some? Because I said I know I could be pretty patient with this, and I'll just sit around waiting for the next three to be filled out, so we could sit here all day on the slide. I hope not to do that. Janelle, you have any thoughts on something that you've seen in the past that fails?
Maybe a lack of synergies, I guess, between the two companies.
That's a great. Yeah, that is actually one of the answers. So very good. So lack of synergies. Russell, do you have any insights or something to add?
Yes, there was one deal that we had tested the seller's forecast that the deal was based on, and their forecast did not hold water.
Imagine that. Imagine a forecast. I'm going to talk about that a little bit later.
So we said no, by the way, because the ROI was like no longer there.
That's right. That's right. Yeah, forecasting is a massive. Well, I'll joke about this a little bit later, just because the reality of pitch decks and typically what they are and they are not. Any other thoughts? That was pretty good for anything else, Russ or Don or Susan?
How about the due diligence, just not matching between the two companies, either too much or too little?
Yeah, absolutely. Yeah, some people are really good at this. Go ahead,
one where we found one deal where in due diligence we found the seller had done some very shady tax filings in the past. And we said, no, we don't want to get involved with that.
Yeah. So uncovering the books, right? You know, sometimes there's some interesting surprises that happen as a result of
especially fraudulent tax returns that I did not want liability for.
Yeah, good for you. Yeah, stay out of that one for absolutely sure. So this is one person's. This is Kaisen Patel of dealroom.net. This was his 5 things that he saw that organizations failed. And by the way, you're welcome to take notes along the way, because I think it's helped go through just from a learning perspective. But you also get, I believe, a copy of this with the notes that we'll be sending out. So number 1 is overpaying. You know, it's fascinating how that's what happens so much. And I think this happens due to bad information, ego, all sorts of different things take place as to why things fail. Overestimating synergies. I think, Janelle, you brought this up. It's a classic problem of, through the synergies, everything is going to work. And then, of course, you find out they're completely separate businesses and you cannot synergize them. Or they're completely different systems you can't bring together. There's so many different challenges that happen here. We're already mentioned bad due diligence. This is pretty good. You know, hey, we didn't know who the company we really bought. I was involved with an acquisition. I finagled it pretty good. I was able to actually figure out a way to get down to LA so I could watch the Rose Bowl. So I literally, I did due diligence one day and then I went to the Rose Bowl the next day. I kind of worked it all out. And I went there and I basically came back and said, hey, this is a pretty good buy if we don't touch them. Because basically we had the margins. They were a contracting company for us. I'm like, we will make money if we don't touch them. And of course, what did we do? We touched them, and it all the value went away, you know, from that perspective. And so you got to understand what you can do, not do. And then nobody brought this up, of course, as part of the reason they didn't have a strategic plan. You know, there was not a clear, you know, the organization, the people were going with, it seemed like an interesting opportunity, but they didn't have a clear goal as to where they're heading. All right, so now we're going to talk about the other side. Same thing. I want your input. Why do companies fail to sell? I was reading some different data points. I saw between 60, 70, 80%. I saw 70% of companies who try to sell don't actually get to sell. It like stops for some reason. Russell, you mentioned already a reason. You know, you went through Give me some reasons why a company may not be able to sell. They have a failure in their sell process.
Sure. One is that the owners have a unrealistic price expectation, and it drives the buyers out.
Yep. That is perfect. And that's ego, right? Sometimes not.
My
but
company's
it's
worth a lot because it's my company.
That's right. What's their baby, right? In many cases. All right. What else?
Maybe not enough good historical information to support forecasts.
Yep. Okay. Historical or financials. Yep. Okay. What else?
Product problems. The product is not as far down the road as we told the buyer it would be.
A little vaporware from time to time.
Yeah. I've
Yeah.
seen that several times.
Yeah. John, what do you have?
A lot of times a company is, its success is predicated on the person at the top, the person that's selling. And there's no strength in terms of the management team.
Yeah. Yeah, that's a great insight of often missed in both on the buy and sell side, right? Who needs to stay? Who can go? Go ahead, John. What were you saying there?
No, it'll affect both, absolutely.
Yeah. Any other things? These are good insights so far.
I'd say, sudden shift in industry or market.
Mm,
I know this past year with COVID, it's impacted a lot of markets.
yes. Great example, right? If you bought a bunch of restaurant chains heading into this year, sorry, right? That's bad, or real estate, commercial real estate in certain areas. There just have been some things that have been, but if you happen to buy into Zoom, good for you, right? There've been things on the good and the bad side in regards to what's taking place. So this was International Business Broker Association and Pepperdine University came up with these 5. And some of these things were, no surprise, were already mentioned with this group here. Unrealistic seller expectations. That was brought up. That was actually number 1 that came up from it. Poor financial records. I think that was actually our number 2 here. So that's 2 for 2. I don't think I've ever seen that. I do this 5 question thing often, and rarely do I actually have 1 and 2 get put out at the same time. So impressive. Declining business sales. This is applied a bit with the COVID part, right? Is that there actually is something going wrong with the business. This is the hardest part, is when something's going wrong with the business and they're trying to get out before it's too late. And it's a challenge. Of course, I recommend, if you can't avoid, I try to help businesses turn around before they sell, as opposed to trying to sell when they're declining, if that's possible. And then this was, seller can't let go. It's my baby. And I'll talk about this a little bit later on that, what we have to do. So if we take these 4 things and all these things side by side, to me, there's some themes in here that are kind of interesting. So we already talked about overpaying and unrealistic seller expectations. Okay, these are pretty similar. Poor financial records, due diligence, misunderstanding the company, target company, waiting too long to sell. Nobody brought this up. And this is something that I'll definitely be talking about today, is waiting too long to sell the business. And seller can't let go. All right. I think this and this are sometimes tied together. No strategic plan. Right. So there's something, but the 4 things that we're going to talk about today that I suggest is these 4 things. It's number 1, 100% commitment. I have been with companies as a CFO. This is hard for owners. If you've been a business owner and you have any reasonable success, you get calls all the time, and it makes your ego go up. And you say, oh, I could sell my business. And I had somebody else call me today, and somebody else called me. I'm not kidding. Some CEOs I know, they're getting daily calls, multiple emails. Matter of fact, they end up, it went over to me a lot of time in the CFO type role because they're like, I can't stand taking these calls anymore. Will you please take them? And then of course they're always tempted. And that's what a salesperson's job to do, is to tempt them into ultimately into buying. But 100% commitment. You need to create value. And we'll talk about what I mean by value. I struggle with this, and if you know my background, and forgive me, it's usually not too popular down here. I grew up in the Oregon area. I'm from Boston originally, but I've been here since Mount St. Helens blew up. So I'm almost an Oregonian, but I'm a Husky. And so to put down a ducks on a form here was a little bit of a challenge, but I put it down here because it makes sense, because everyone understands ducks in a row, and even had green color in there. So I'm a little frustrated by that. And then time is now. When is the time to get ready? The time is now. We'll talk through this. So these are the 4 key elements. I love this picture, right? It's sort of like the concept of you're all in or you shouldn't be in. We want to have a number. We want to commit. And so when you jump out of an airplane, you can't jump back in. That's in my belief. If you want to truly go in and do a strategic plan for an exit, the ownership team needs to be committed to going out. And so some of the things around this is you need to be 100% in. And I think you got to stick to your core values, whatever they were or are. And what's sad, and I'm sure you've seen this, if anybody has a good story, let me know, and you can feel free to jump in. What's sad is you could be the greatest human being in the world, but something funny happens when dollar tables, when there's money gets involved, and when it's a lot of money especially, and all of a sudden all these wonderful core values sometimes go away, and our legacy and our reputation gets faltered. So I suggest go all in, but try to do it committed to what your core values are. So that's part number 1. Number 2, I'm sure people here who can relate to this. I think one of the biggest problems of commitment and why people don't commit is they don't think about what's next. What's going to be next for you as an owner when you've got your X dollars in the bank, you got 7 figures in the bank, 8 figures in the bank, whatever it is. What are you going to do next? For me, if I love golf, but I couldn't sit and play golf every day. I know for myself, I couldn't retire. But the problem is this vision that people have, like, oh, I'm just gonna play golf and I'm just gonna walk the beach every day. And there's a reason why this person made a lot of money in a business. They are not wired to sit around and play golf every day. And so having a vision for what is next, not only for the owners, but for employees as well. Now I put down here team versus family. What does that mean? You've probably one of the companies that this is my family. This is my family. And whenever I hear that, I appreciate it, but it's not a fact, first of all. Well, sometimes it is. There's family run businesses. So let me care for that statement. There are family run businesses, but most people aren't who are employees of a business that's ready to be sold. And Reed Hastings, who still runs Netflix, he had this very interesting, he says, no, I don't call our team a family. I don't call our company a family members. I call them a team. And the reason why I call it a team is because you can't fire your family. I mean, you can't, it's very hard to fire your in-laws or your family members or your wife or whatever it might be, your spouse that's involved with something. And so having the element of that, this is a team, and I'm willing to basically sell my organization to somebody else, like an owner would, and like a professional sports team. You got to have that ability to be able to do that. Because if you don't, this is where a lot of time, I remember I was with a company, one of my actually favorite company I worked for, and we had an underperforming sales manager, and for a number of years. And I had multiple comments about, I wasn't even the direct person responsible, but it was impacting our sales and marketing. And the CEO said, Carl, I can't fire this person because they're like a son to me. I ended up leaving the company within a few weeks The sad part is they ended up leaving like about 3 months later, and I may have stayed. Because what happened to me was all of a sudden we weren't thinking rationally about people's performance because there was this feeling of family. So I think if you're selling, you have to think more like a team perspective versus a family. Lastly, we need to be humble about, that's just my, if you could be more humble and get away from the ego concepts around the sale, you're more likely to get to a sale to begin with. Along these lines, to help confirm it, this actually comes directly from Harvard Business Review. Lynn, you probably saw this. I think you were in the previous presentation I did on Tuesday. Two things to think of, and this is great. This is from nearly a decade ago. By the way, if you are Harvard Business Review on HBR, you can download slides and use them for your presentations. They've given permission for people to do that. I'm not obviously reselling this, but you could use it for purposes of giving them credit. But number one, you need to be able to summarize your company strategy in 35 words or less. This is going to help you with selling, because you know the direction and what you're trying to do. But there's a second thing, statement number 2, which is, can you summarize your company's exit strategy in 35 words or less? So if this is all about that commitment. If we could commit and say, this is who we are and where we're going, number 1. And number 2, this is how we're going to exit. Knowing it's not going to be exactly how you ever dream, right? Dream about. But if you could get those 2 things, it's going to create so much more synergy as you're moving forward. All right, so area number 2. So actually, before I move on, as we group, any comments about the area number 1, commitment? And does anyone have an example of where it didn't, because of a lack of commitment, you ended up wasting a lot of time, money, resources? Can anybody throw up an example of that? Patience. Well, I can give a personal example since nobody's throwing one out. I was with a company and we were getting ready to sell. We're considering selling, and actually made the recommendation to the board. I had a board presentation just like this, and I said, here's all our data. I recommend that we sell based on these factors. And I was relatively young then. People probably think I'm still young now, but I was really young then. This 15, 16, 17 years ago. And they laughed at me and they say, silly Carl, ha ha ha, nice, thank you for your input. And they moved on. Sad story is it took them 10 years to get back to that value again. There are times that when we had to commit and we need to be ready to move. And if we don't, you end up losing value. So how do we create value? So the easiest known method, and I'm working with venture capitalists right now, they see the world as EBITDA, which is, I think most people here with experience, and I know most people experience, is earnings before interest, tax, depreciation, amortization, EBITDA. It's generally a perspective of cash flow. And so you could easily compare versus other businesses. This is the core. This is the core multiple. Now there are multiple other ways, of course, that a business is valued, but at its key element. Now, this isn't as true for SaaS companies. SaaS is typically more a multiple of revenue because they're not making any money and they're not going to make any money for any time soon. But for most of them, that EBITDA is it. And what's good is there's a lot of good data out there. I just pulled this from the internet and it's reasonable. These are reasonable information. It's pulling from actual data points. This is from Equidam. You could pull up all this data, and if you're in aluminum, right, you can figure out that, hey, if other organizations right now are getting 7.57 times EBITDA, that's a data point. It doesn't mean it's going to be your organization, but at least it's a data point to compare, to understand value. So it's really simple. If we increase EBITDA, our value goes up almost all the time. This is like simple math. And it's probably the easiest way to help get through to understand how that would take place. I'm a big believer, once you commit, you should hire a third party, a trusted broker who is not on your board. Literally, I mean this, not in your board, not an existing shareholder, but there's somebody independent that can give you a, what I call reasonable assurance, I'm not going to write it down here, that, hey, this is a fair value for your company. Because even some of these EBITDA numbers are inflated sometimes, or it's not appropriate for your organization. And so getting somebody you can trust and say, hey, Carl, this is why these companies are here, but this is why other organizations are here. So really hiring somebody you can trust, and there are some great people in town here in the Portland area that do this, and but you should definitely look at that. This comes directly kind of from GE, Jack Welch, but I've seen this time and time again, is you want to become number one or number two in your niche. I love Russell Brunson, somebody I like to follow. The riches are in the niches. Now, what does a niche mean? It basically means you have a defined territory, geography, group of customers that you've defined that this is what we're number one at. So I love this little chart here, right? Because you might just be number one right here. You might be, for example, the number one hot dog maker in Gresham. That's your business. Now, I don't know how many people are going to buy a Gresham hot dog maker, but that's the type of concept, is that we're going to be the number one hot dog maker in there. Other people are going to be like, we're going to try to win this whole territory, or we're going to be number one or number two in this product. But what this does from the selling and buying perspective is, A, it gives you focus as to where you should be putting your time and money. Number two, what it does is it gives the comfort from the people who are buying you that you actually are good at something. And so what that will do is it'll actually bring up your EBITDA value, because people are like, oh, they actually, if something happens, they're still going to be number two in this. And this doesn't mean just one customer, by the way. This is not about concentration risk. This means you have multiple customers. I prefer in a business to have nobody greater than 5% of my customers. So that's something that I always strive for. So number one or number two without anybody bigger than 5%. If you have something like that, you have a pretty legitimate, credible business. You've probably heard of the 80-20 principle. And it's basically, from a simple perspective, is 80% of our efforts. 20% of our efforts have 80% of the outcomes. Okay. And so this is what's crazy. So we focus our time on the 20% of sales and operations that impact 80% of our business. This is a little bit against the common culture grain right now. And forgive me here, I'm not trying to say, but from a business perspective, not everything is equal. We need to spend time on the things that's going to be driving towards. So going back to that number one or the niche, we focus our time on the niche that we could be best at. We're going to get focused on that to get 80% of our business, and then automate or eliminate the rest. Literally try to do what you can, because this, almost all the rest of this 80% down here, that's taking 80% of your time and only 20% of your revenues, is probably losing you money. So we have to find ways to eliminate, automate it. And in many cases, organizations have become better. Sometimes they actually get rid of a key customer because it might be a top 5 customer, but they actually end up getting rid of it because they find out it's taking 80% of our time to manage them. So we have to use these tough 80-20 principle rules. All right, so now number 3. So I offset this ducks in a row concept by putting my kids in here. This is cute. This is like from 10 years ago. This is in Florida. And there's a bunch of cute little ducks here. It was really cute. Sorry, this is my emotional part right here. I got 4 kids, and so they're all getting too old now, and not so fun. But the ducks in a row I'm referring to here is your leadership team, financial records, and information systems. We want to have all 3 of these things in an area that we're moving forward. So leadership team. This obviously depends on the size of your organization. If you're a $5 million company, you're not going to be hiring a $300,000 a year CFO, right? You're not going to be hiring a $400,000 CEO type stuff. But depending on the size of your organization, you need to assemble the right key leaders to help make sure that your organization is working properly. So that's number 1. 2, ideally they have growth experience, because how you increase your value is to grow EBITDA. right? Not just grow revenues, but to grow EBITDA. And so we want to work through that. So people have different thoughts on this. I like to work through transparency as much as possible. So there's some people like, I'm never going to talk to anybody about it again because it might not ever sell. The problem is that ends up happening for the owner is they're not being truthful about what's really going to be happening with the company. And I understand it because I've been involved with organizations who do that. But I believe in general, your leadership team needs to know what the goal is. If you are 100% committed to selling, you want them 100% aligned, right, to getting it done. And ideally, they have some stake in the outcome if something happens, right? Because leadership is always at risk, but often people are buying a company because of the leadership team that exists. They buy it for their people, they buy it for their products, and they buy it, sometimes they buy it for their intellectual property that they have. In rare cases, they're buying it to get rid of you. That does happen from time to time. They're trying to get rid of a competitor. But at the end of the day, they're buying it often for the leadership team. And so they want that leadership team to be there. And if you set up things in place that, hey, they're not going to get, they have some type of, agreement where they're going to get some type of reasonable severance, they're not going to be looking for a new job the whole time where you're saying, hey, we need to grow this company more to help hit our EBITDA number. So I think this is huge with the leadership team. All right, so I did say don't hire yourself a too expensive a CFO. I was a former CFO, so but you do need to hire a CFO at this point, in my opinion. If you need to have somebody who's strategic, not just getting the numbers. Now, theoretically, you can hire a part-time person to do this for you, and you're just going to have a controller to make sure that the books are clean. But that's number one. So these two go hand in hand. You need to start doing an audit, and you need to have it to be a reputable firm enough that the acquiring company is going to feel comfortable with the audit. And people go, when do I need to start doing an audit? Well, if you're going to sell in 2 years, you need to get the balance sheet done now. You need to get for the previous year, the current year, you need to get the other balance sheet done so you can actually do one full income statement. Ideally, you can get 2 years of audited financial statements. That's why a lot of times I said to people, you should, be ready. If you want to sell in 3 years, start working on it now. And this is one of the key things you need to start working. By the way, you can always get an audited financial statements done for the right price at a condensed version. It's extremely painful for everybody who's involved with that. But do this as soon as we can, and then start organizing all your legal paperwork, your patents, any type of things that's intellectual property. Make sure this all together, because there's a huge set of due diligence that takes place. And if this is not clean, as mentioned before, that we were talking about reasons why you don't do or don't sell, this will end up hurting you. All right, information systems. This is often not brought up. And Peter Adams is one of my favorite. I'll just a little shout out to him. I've worked with him in the past, and he has spent his whole career working with organizations on being prepped for sale, because what happens often is when systems aren't there, they'll end up being discounted, or there'll be holdbacks on the sale. This is one of those really sad things that not understood in sales, is often there's these huge holdbacks that could be significant part of the deal sale. And if these things fail, the owners never get this money. And so the ways to end up cleaning things up is to make sure you have the right systems in place, so you don't get basically this is all about, often it's not going to add value to the sale, but it's going to prevent it from going, we don't want the value to go down, and this can help prevent the value from going down. That's what we're trying to do here. And that's the purpose of having clean financial systems. This is something, as opposed to, you can outsource. You don't have to have this be a permanent solution, but you definitely want to have a team, and you want to avoid surprises, right? They don't want to find out that all of a sudden the data is not clean, there's a bad ERP system, or with a company you're working with right now, and they're still using ACT as their CRM database, right? And there's no updates to it. And it's like, oh my gosh, who are our customers, who are our prospects, and what's our opportunity? And it's actually, we don't know. And so this is the type of things that have to be improved. And this is what is our number one priority right now, is to get a new CRM system in. So these are things, and this is a company I'm working with that's looking at making changes down the road. So the last key point and element here is the times now. So what does that mean? And when I was doing research on this, so I want to ask, before we go into this, I would like some input on this. When do you think an organization is worth the most? So it's a kind of weird question to ask, but when do you think the value is the greatest for the company? So throw out some of your ideas.
After a new product launch?
Okay.
Strong upward trend in growth and excel quickly before the trend turns down.
Oh, you just totally ruined my next part of the presentation, but that was brilliant. And just because it's like my biggest point, I like to say all the time that have never talked about online beforehand. So absolutely, Calvin, that was a huge insight, and we'll talk about that a little bit more later. What else?
Well, that wasn't Calvin that answered, but I will answer now.
Sorry, who was that? Forgive me. Who did answer that beforehand?
Oh, Russell.
Oh, that was Russell. Sorry, Russell. Okay, Calvin. Since I improperly, thank you for not taking credit for that. What's your thoughts, Calvin?
Well, it's along that product launch line, but it's more of sort of a first to market, not necessarily a new product launch, but first new technology or those kinds of things.
Yeah. Okay. That's good. All right. What else? What are the things where your value is the greatest? Any other thoughts? Going once, going twice. We'll stick with 3. Okay, but these are pretty good. And this is like literally is like the one I was kind of hoping to see, but and we saw it. So here we'll talk more about that. So this is, we could spend hours talking about DCF and valuations, and we are not going to be doing that. Okay, just to clarify in this meeting and get into all the different nuances on the value of a company, but just some key elements behind. Hopefully, risk rate or return and interest rates. It's like as low as it's been ever, right now. And so this is actually increasing the value because interest rates are down. It's increasing the valuations for companies right now because there's not as good alternatives to go into. That's why the stock market's so high. Industry comparisons. So we talked about this earlier. We're going to be checking on not just industry comparisons for EBITDA, but we're going to be checking versed on market size or product definition, or how many people are going to the website versus other websites, right? These are different elements we're looking to compare. We talked about this. We want to remove the think ducks in a row. We want to remove the discounts that are taking place. So what happens whenever there's less confidence about the value of a company, and I love appraisers because they're like, everything's exact and there's a science behind it. But the reality is whenever there's less confidence, the discounts go up, meaning the value goes down. So if something's weak in any of these, the discounts go down more. And I know there's appraiser evaluation things, but it's always kind of interesting to me of like, oh, why did that discount go up? And they'll give some reason and rationale. It was like, oh, the value went up. And it's like, it's significant. Like these small % things could have a huge impact on that. Asset value, right? How much is the value of your assets? This is hard when it's IP. It's hard when it's sometimes a product, but that's going to have an impact. And then the growth curve, and we're going to talk more about that. Once again, this was brought up beforehand by Russell. Okay, so how many of you raise your hand or put in the chat or put in a happy face if you've seen this pitch deck graph beforehand? Come on. You haven't seen this beforehand. Every company goes to 50 million, right? You know, it's the classic, of course we're going to go to 50 million and this is why we're selling our business. You know, this is, I'm involved with a company right now, a completely different company I haven't mentioned. This is the pitch deck we're working on. And it kind of makes me cry a little bit because I've seen this so many times, especially in the CFO role. Every company grows up like this and it goes up forever and everybody's happy, you know? And now I have been with companies that have been like this. So this has happened. I have had this experience, just so you know, but it's not the normal experience. It's not typically what takes place. So the challenge with this is, you know, there's kind of like this, I promise it's right, you know, and you know, an accountant can come up with any pitch deck you ask them to put together. It's not their fault. They're just a bean counter. Oh, of course it's going to go to 30, 40, 50 million. Of course it's going to happen, right? But then Russell brought up the huge insight that I think is often missed by organizations, is that there's revenue growth and then there's growth rate percentage. And when your growth rate percentage doesn't go up as anymore, the value of your company typically goes down. So even though we're creating, by definition, more value in the company, even by an EBITDA perspective, the growth rate, you're never going to double again. This happens so many times with companies. So if you look down here, if you look in the details here, this company is going from like 10 million to 20 million roughly. That just doesn't happen very often. Now, SaaS companies are like one of the few companies that can sometimes pull this off on a repeated basis, but even a big SaaS company will start not having the same return rate. So as a result of that, when these goes down, all the returns and all these different areas end up declining. So Russell, when do you sell here?
Well, I would probably sell around 2021 or 2022.
That's right. That's right. This is the prime spot.
The problem is, though,
And
when I've talked to owners, they see that growth and they get so enamored saying, well, I don't want to sell because it's going to keep getting more valuable because it's going to grow more. And the answer is, well, yes, but you never know when that dip's going to come, and then you'll panic and sell at a downturn and lose all your value.
Russell, you should have done this for me today. that is just magic information. And so let's talk about this a little bit more. And it just, so you just nailed it. When you're at this growth rate and you just doubled, you grew 70 to 80%, and you're even in the next year going, hey, we're going to get to 32 million. Hey, it's only 50% growth. Now, what's missed is that same revenue growth is the same revenue growth from the previous period. So this is hard work. There are problems. So there's a stair step of problems that happens that most business owners don't pick up and understand until they go through it or they've been through it before. There's a stair step problem that happens along this way. And the problem is your controller or accounting manager who were able to handle a $10 million company for you might not be capable to handle it at 40, 50 million. Like literally, this happens all the time. A VP of marketing, the person who ran your sales department at a $3 to $5 million business cannot do a 40 million. So this is where I go back to the Reed Hastings of Netflix, why he calls things a team. If you're serious about selling, you have to have this team mentality, because people who were superstars and rock stars with you at a $10 million company might not even be in a director role, you know, if they're even with the company. And honestly, they might not even want to with the company when that 40 to 50 million, because to them, it's going to feel bureaucratic and it's going to feel challenging. And it's like, why do I have to follow these HR policies, right? These are the changes, the different things that take place with the changes. So what Russell said is so huge, is that sometimes the greatest value, and the reason is this: assumptions and projections, you can never predict the future. Like, right? If you were a restaurant and like you're thinking, let's wait 2 more years to sell because we are about to hit $40 million because of all of our new restaurants. Oops. Right? Oops. This is that's the type of stuff that happens. Tax changes. I know somebody who he had a massive bonus, and I won't go in, that he didn't get because of the tax changes that happened, the tariff changes from with China. It totally impacted his business and his margin. Trade wars. We were talked about tax changes. Tax changes. What if hey, it's projected taxes are going to go up. And by the way, this has also helped the stock market go up because of the change in administration. That's going to impact negatively your EBITDA. That's going to negatively impact. These are things that you would have necessarily predicted 6 months ago, but it's happening potentially now. A key customer leaves. This is why, once again, I like to have nobody greater than 5% of business if possible. Hey, if one key customer leaves, all of a sudden, see how that little promise ends up becoming a promise, we could do this, right? It doesn't end up happening. And so the reality is our results may vary. So this is only showing 35 million here. And we were saying we were going to be a $50+ million company here. But the reality, the cold hard reality is we're only going to be a $35 million company. Your valuation is going to be at half or worse than it was when it was back here. And it's like, yeah, we can make more money, but you just don't know. And this is where, once again, I think the time is now for organizations to be ready and be prepared to sell. So this goes back to it's an inflection point is we should be running scenarios of what could happen and what may happen. We should be running more than one scenario, right? There's the perfect pitch deck scenario, and then there's reality scenario. And then there's perhaps, hey, we raise more money, we could put a bunch of new salespeople or a bunch of new digital expenses or a bunch of ad advertising into it. We can grow and do X, Y, Z. But do scenarios. As I said, right before or right during the inflection point, and just pitch decks really turn into reality. So that, my friends, is the 4 things that obviously there's some subpoints behind it is I think to help create a more successful strategic exit and what we should be thinking about when we're doing things. Number one is we need to be fully committed and all in to what's taking place. And as deep as you can go with that, even the better. 2, we need to create real legitimate value, not just website hits. Meaning we actually have to have real earnings and growth that is actually growing our earnings as well. 3, we gotta have our ducks in a row. Let's make sure all of our accounting, our legal, our leadership team is in place and ready to make changes. And finally, you need to be ready to say the time is now. And by the way, this experience that I've had where making a recommendation to sell now and the owners decide not to, in those both internal cases where I've been with companies, both times they did not achieve the value they could have. And it took, once again, multiple years to recover. And that's like the worst thing in the world. You think you're worth whatever, and you're not, right? And I'm going to go back to this 100% commitment and thinking about what's next. I think owners have to legitimately ask themselves if they're not getting more than 2 to 3 times their personal compensation on an annual basis, unless you're trying to get out of it because you don't want to get out of it, why are you selling that for just 2 to 3 years? Unless you're truly at retirement, unless you're truly at a point where you're not going to be working anymore. But if you still have gas in the engine and just your DNA of what's happening, have that next step plan of thinking about how much is it going to really take for me to walk away and be committed to try to get that for not only yourself, but for those who are around you, other shareholders, leadership team and employee members. And then even consider, hey, maybe I want to be a part of the next ownership team. if that makes sense for you in the organization. But I think thinking about what's in next and get it, because there's a lot of people regret. I know owners who have come back to companies because that company who acquired it took on way too much debt, and they're in a worse situation than they were before. They got a little bit of money. They weren't able to get all their full money back because it didn't meet. There were certain things that had clawbacks, and then they find themselves running the company again with a bunch of debt. Not a good situation to be in. So think clearly through these things to help make sure that we're doing the right things. So just some couple little follow-ups, and then I'm going to open up just other questions or comments, and we'll have a few minutes to head out early if you'd like. But one of the things we do is do strategy assessments, and feel free to catch at 40strategy.com. Feel free to send me an email if you'd like to learn more. And I lots of ways to stay connected with me. I'd love to hear direct comments. Carl, that was terrible, and I don't know why you're doing webinars, or like that was the best things in sliced bread, whatever it is. I'd love to hear it because it hopefully helps make my presentations better. And it's funny, we were talking about earlier that I did the first webinar for TAO presentation because this is when COVID hit, and I just happened to be set up. And so this is kind of my approach and presentation is a little bit different than most people do it. I'm on LinkedIn under Carl J. Cox. You can email me, Twitter. I'm not on a ton, and I'm just launching a new podcast called Measure Success Podcast. And through referral, we're bringing in people who are just successful business leaders and sharing their stories of how they have created success, not only in their business, but in their personal lives as well. So that's kind of the last part. Thank you very much. I just would love to hear, if you feel comfortable, any thoughts, comments, suggestions. What did I leave out that I should have put in there? So I'll just leave it open here, and I'll feel welcome to be vulnerable, even if you think I'm terrible. So please, love to hear it.
Carl, it looks like Susan has a question. Susan, you're
Okay.
welcome to unmute if you like.
I'm sorry, that was a raised hand from, I don't know how to delete the hand.
Hi, Susan. We can't hear you.
Oh,
Do you have
sorry,
a question?
sorry.
No problem.
That raised hand was from your last poll. I didn't have a question. I'm not sure how to undo the hand.
There we
No
go.
worries.
I unmuted it. Don't worry about that. Carl, one question I had, I mean, this is not in my wheelhouse at all, but who should be involved in this plan for exit? Like who in the team? And then what happens if, let's say you have a partner and they're not on board with it? How, I mean, I'm sure that happens quite a bit, but I'm just wondering who on your team should be involved. And then also what do you do if some of those people who should be involved are not pro that plan?
Great question. So number one, I said, this is my belief, not everybody's belief, but my belief is you're 100% committed and you get as many people involved as you reasonably feel comfortable to get involved with it. I can't answer that for each organization because each organization is run a little bit differently. What we don't want to create is an exodus of people, right? Because we're thinking about exiting. That's like the worst thing that could take place, but you need to have trusted people within the organization that are critical for you moving forward. But I honestly don't think it's healthy for the single CEO to take all the burden and all the frustration, and all the pain and all the right and go, I'm in this by myself. And then all of a sudden they surprise everybody one day by saying they're selling. I just don't think it's healthy. I don't think it maximizes the value of the company in many cases. And so I think they need to find the key leaders. I can't tell you, specifically who they are, but I like to have ideally the entire senior team on board, whoever that is, to go through that. And you had a secondary, forgive me, what was the secondary question you had?
What if you have a partner who is not on board with selling?
Well, you can't sell, or you're gonna have to buy them out. So this is often why things don't get sold, is because many organizations do kind of start out as a partnership and then they turn into a real company. And what I mean by a real company, they have a bunch of employees and you need to both be all in. And especially if they're an owner, they need to be all in, because if not, it's no different. It's about engagement, right? And Gallup does a bunch of polls on this, and they talk about, whether you're engaged or not engaged. You need to have people fully engaged. And if not, they're going to be undermining the whole process. And that is the worst, right? If you like have two people and they're like all do, oh yeah, I'm good. And then they're telling everybody behind your back, oh, I don't want to sell. And that's going to come across when due diligence takes place, if it gets to there. But they will undermine everything along the way. And so this is when people end up leaving companies often, is because of they don't want to be a part of that. And the really hard part is then how do they get paid out when there's not enough cash to pay them? Super difficult and challenging problem. And there have probably been multiple books written about the pain and suffering around that. But that needs to happen and take place for there to be. There is a great book, by the way, though, called The Hard Thing About Hard Things. I don't have it in front of me right now to show. I think is a great discussion of there are those pain points that have to happen, and you have to have those tough conversations. But your partners, I once again, going to your question, partners need to be on board, or you need to make a change.
Thank you. Are there any other questions out there? Feel free to unmute and ask Carl any questions you have before we have to go.
And there are, I do want to make one little final comment, because I've been involved with the really happy, exciting, wonderful, everything's going up and you sell for a really good valuation. I've also been a part of the companies that have completely run out of cash and they need to sell now. And all I'll say in that latter part is, if you have to sell because you're going out, you just got to be super fast. And this is where I go back to the time is now. Like I've been with organizations where they've had like a week of cash left. It is scary stuff, super scary stuff. I was with a publicly traded company where we went from 50 million to 6.5 million it was over a period of time. We're getting ready to report. And if we didn't collect 11 million by the end of the quarter, which we ended up doing, we were fortunate with, we probably would have been delisted off of NASDAQ. I mean, it was scary. I've been involved in things like that, and it is super scary. But this is why, once again, trying to sell when we have the highest value and getting people on board, I think is so much of an easier and a more thoughtful way of doing things rather than the panic sell. So. Any other inputs? Russell, you had some great insights. Anybody else, any thoughts on this presentation? Something that I left out that you would add, recommend?
Well, thank you so much, Carl. Once again, it's always a pleasure working with you. Your presentations are always so insightful and full of information for our community. Thanks for bringing us full circle, bringing us back into 2021, especially with the lockdown and our virtual events. So thank you. Thank you to everybody who participated today. We'll be sending out a survey, and we'll also send out the slides that Carl put out today. And this should also be up on our blog and on YouTube, probably later tomorrow afternoon for everyone to access in the future. So we hope you will continue to be a part of TAO events. Next week, we actually have no events, which is crazy for us as an association. But the following week, we have our Power Pairings event on, I believe it's February 8th. And then we also have an IM Tech Oregon event as well. So we hope you will join us for that. And enjoy the extra 25 minutes of your day. Hopefully you'll get outside before it starts raining. Have a great afternoon, everyone.
Thank you so much.
Thanks.